Hey everyone, welcome back to Intermediate Financial Accounting 1. In this class, we are going to continue to talk about PP&E. Specifically, we are going to talk about PP&E impairment, the disposition of PP&E, and the exchange of PP&E. So in last class, we talked about how to calculate the capitalized cost of PP&E and how to calculate the depreciation of PP&E. And the last issue here is impairment. So as we talked about in last class, depreciation, it is a cost allocation process, and it does not attempt to measure the current value of the asset. Situation may occur that the current value of the asset may decrease below its book value. And in this situation, we will need to write down the book value of the asset to its current value. And this process is called asset impairment. So when and how to recognize asset impairment, we have two steps here, specifically for the impairment of PP&E. The first step is when. So when should we recognize impairment for PP&E? We need to compare the undiscounted future cash flow of the asset and the book value of the asset. So the keyword here is undiscounted. So this is the part you should pay attention to. The undiscounted future cash flow is basically, we estimated the future cash flow of an asset, for example, cash flow in period 1, cash flow in period 2. And then we just add them up. So cash flow in 1, cash flow in period 2, cash flow in period 3. We do not need to do any discounting here. This is the undiscounted future, the sum of future cash flows. We don't do any discount here. And this is first step. And if in the first step, the undiscounted future cash flow of an asset is smaller than its book value, then we move to the second step. We need to do asset impairment. And then in the second step, the question here is, how much do we need to impair? So how much impairment loss do we need to recognize? Here to calculate the impairment loss, we take the difference between book value and then the fair value, or the fair value is the discounted future cash flow of the asset. So this discounted future cash flow is basically, in the second step, we need to discount all of the future cash flows. And as you can see here that the discounted future cash flow is always going to be smaller than the undiscounted future cash flow because the discounted future cash flow, we need to divide it by a discount factor. So this is the second step.